John Miller, Munis are making a comeback in 2014 after a rough ride in 2013. Why is now a good time to buy high-yield Munis?
First of all, the muni market overall was beaten up in 2013 and ended the year, we think, oversold based on some technical pressures, tax loss selling at the end of the year, and even more so in the high yield area. So it starts off the year at a cheaper price. That means a higher level of income. A muni high yield trades with a AAA yield plus a credit spread or a yield premium to compensate the investor for the credit risk. We think the credit risks are somewhat overblown in the macro sense. Of course, you have to be selective on individual choices, but there are a lot of economic growth is benefiting municipal credit, and that should help credit spreads to narrow. Also, as the muni market improves in 2014, as it has so far, and we think it will continue to do so, the more beaten up components of the asset class have further to run to the upside, we think.
Now, we know that Puerto Rico has been beaten up, Detroit has been beaten up, but we got word, I think today, that Chicago has been downgraded by Moody's. This is a huge American city. Now, would you go out and buy those bonds?
We would consider still purchasing Chicago GOs, again, at the right price and with the right framework and potential outlook. What we see going on there is as follows. First of all, it's a very large, very diverse economy which is growing. Their sales tax revenues are growing, their property tax revenues are growing. So we think they don't have, in the broadest brushstrokes, they don't really have a revenue problem. But they do have an unfunded pension obligation problem, the same problem that has Illinois as a state in a lower rating category than we think it should be. So if they can turn around that particular component of their credit, they could be a strong credit once again in the future.
But one would have to assume that Chicago is not the only city out there with unfunded pension problems. Actually, we know they're not because we keep hearing about them all the time. So how is that going to affect supply and demand? Are you going to see a lot of municipalities go out and sell lots of bonds now while they can before these pension problems really hit and they're going to have to start fighting with the unions?
I think that selling debt is not a good solution to an underfunded pension problem. And in fact, it's actually a red flag if you're going to try and cover up a pension problem with more debt. And we've seen different municipalities do different things. Encouragingly, almost every state in the country which has had an unfunded pension has done some type of reform to reduce the growth rate of those obligations. In addition, hundreds, if not thousands, of individual cities and counties have also embarked on reform. So this is a very complex area, but it's also a very broad and diverse marketplace with over 65,000 different issuers in it. So I think it's important to shine a light on this issue. It's important to look at underfunded pensions where they exist. The ratings agencies, as you can see from the Moody's downgrade of Chicago, the ratings agencies are taking it more seriously. They're downgrading credits if they haven't funded up their pensions appropriately, and that's actually a good thing for the investor in the long run.
All right, thanks a lot, John.
Thank you.
Thank you for watching The Street.